Welcome to Trading Nation. I'm Mike Santoli. The market is ending a wild 2018 with an even wilder December. The S&P 500 averaging a daily range of more than 2% for the month. These swings this year leading the VIX, the Volatility Index, to have a record 13 one-day moves of more than 20%. Our next guest says you might want to get used to this volatility. Mandy, Director of Equity Derivative Strategy at Credit Suisse, joins us now. Mandy, good to have you here. So I guess one question is, place the current bout of volatility in some kind of a context historically. Is it unusually high? Is it an unusually prolonged period of agitated markets right here? What do you think is actually going on here in this second big correction of 2018?
Yeah, sure. I mean, I think what's unusual about this one is not unusually high, but the biggest move in the options space actually is not in the VIX, which everyone looks at, but in longer dated options this time around compared to, say, October. So keep in mind that the VIX is really just a measure of 1 month implied volatility. And, it is back to the levels that we saw in October, but this time around, implied volatilities of longer dated options have actually seen a much bigger move. Now, it all sounds a little bit technical, but I think the implication is actually quite important. What the market is telling you is that unlike in October, where the VIX went up, the market was saying we should see a quick normalization in volatility. Volatility should normalize 2, 3, 6 months out. Right now, the market is saying that actually volatility is likely to stay elevated in this current range for the next few months. So we're maybe in a different volatility regime. I wouldn't call it high volatility, but certainly medium vol, where VIX is trading high teens to low 20s.
And so when you see investors essentially bid up implied volatility in further out months, that's predictive of how the market is likely to behave. In other words, it's not something where you say, oh, that's a contrary signal, it's probably going to calm down from here?
I don't think it's contrarian, but I do think it's a reflection of the fact that the risks have changed. So if we think back to, for example, in October, I would say back then the risk that everyone was focused on was very much earnings, right? Upcoming earnings season, are we going to get good guidance, bad guidance, are the numbers going to hold up, etc. This time around, I think the risks that investors are focused on are not something that's going to be resolved in a month or two, right? We're talking about economic growth. Is a recession coming next year? We're talking about Fed policies. The Fed going to raise rates twice or maybe not at all, which is what kind of the market's pricing in. We're talking about things like trade. These risks, we're not going to see resolution anytime soon, and that's why we're seeing longer dated volatilities being bid up is a reflection of that fact.
And I guess, how does that translate into how an investor might either set expectations for the coming year or position him or herself for the coming year?
Sure. I think, probably the most notable thing about the positioning in the options market this time around is just how constructive it's been throughout the past few months. So as the market has sold off, almost 10% since the highs, we've seen not only a lack of demand for downside protection, but actually recently investors coming into buying upside calls, right? Saying that actually on balance with markets where they are right now, the risk is to the upside. So I think, one measure that we look at is the Credit Suisse Fear Barometer Index. It's a measure of the relative demand for puts versus calls in the S&P. That has fallen to a 5-year low, right? So I think that's quite remarkable and goes to show that, even with all the looming risks out there, I think where valuations are, where markets are, investors are starting to dip their toes back into the market.
Now, I've also heard an interpretation of that effect where basically there isn't much demand for downside protection as being, well, maybe investors have raised more cash or they found other ways to feel as if that they're already insulated a little bit from these moves, or we've been in this elevated volatility environment for a few months now. Maybe they have kind of already bought some protection. I don't know if that makes sense.
I think that's part of the driver. I would say particularly in October, where we did see, significant degrossing on the part of, hedge funds and institutional investors. So as you sell out of your positions, obviously there's less need to hedge. But I would say in recent weeks, it's not just that there's lack of demand for downside hedges, but actually real demand for upside calls.
Interesting. All right. Folks making a bet that this is just a maybe passing storm, even if it lasts for a little while longer. Mandy, thank you very much for joining us today. Appreciate it.
Thanks for having me.
And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.